Hello, everyone. Welcome to another episode of the Wealth Tech Insider. My name is Danny Legrand, and today I'm joined by Peter Warren. This is a two-part podcast, and we released and launched part one earlier this week around our 2024 predictions. So in part one, we looked back through our 2023 predictions and saw what we got right, what we got partially right, and what we got completely wrong. And Pete, happy to report we got a perfect score. We got all of our predictions right for 2023. Today, in part two, we're going to look at our 2024 predictions and have a chat through what we think is in store for wealth tech this year. We get really excited about what's potentially going to happen in wealth technology, and our predictions focus on that intersection between broad technology trends, the local tech players, and advisor and licensee needs. Hey, Pete, how you going?
Hey, Danny. Really good, thanks. Hopefully, we can stretch ourselves a bit more this year with these predictions and get a few wrong.
Yeah, we've sort of,
I don't think we're trying hard enough if we don't get at least a couple wrong. So
yeah.
let's have a crack.
I think we might have gone a little bit riskier this year. So let's get stuck into it. All right. So these are our predictions for 2024. So I think we're probably feeling a little bit optimistic about 2024 when it comes to our industry and the technology that supports our industry. And advisors are really starting to think about the tech stacks, efficiencies, client engagement, cybersecurity, especially, and some of those potential regulatory changes coming down the pipeline with QAR, and looking at technology and recognizing that it can really sort of support what it is we're doing every day in our advice businesses. All right, so prediction one for 2024, we've got the emergence of AI washing in wealth tech. So AI washing, I guess, is prevalent in wealth tech, and with companies often sort of potentially overstating their use of AI. And it's where companies sort of claim their products are powered by advanced artificial intelligence, even if the reality is that it's not really there, or it's quite minimal. So we're cautioning against startups heavily branded with AI, as we think that many may not sustain things long term. What do you think, Pete?
Yeah, Danny, I think this is. I mean, you've been onto this for a while, right? Even in the back half of last year. I guess the term AI washing is a bit of an extension of what you see with greenwashing
Mhm.
in investments, which we are not experts on, but we're aware that it's a real problem for the sector. Tech always has an element of any sort of fad washing happens, and we see this at all sorts of different parts of the cycle. So I think augmented reality was one. Crypto was probably, there was a bit of crypto washing happening at different times, or blockchain washing, we'll call
Mhm.
it. And the .com thing 20 years ago, right? Or 23 years ago now. So we are absolutely at that stage of the hype cycle, 100%. The reality is that, venture capital funding for AI related businesses, either through seed or through Series A, is up 60% year on year. So, the companies that are claiming to have AI are getting venture investment. So it's no surprise a lot of businesses are going to stick, an AI brand or some description or name into their company to try to attract investment and attract high valuations. But there's a really big difference between a company that's actually building its own AI, its own intellectual property, versus ones that are simply taking AI like ChatGPT or Google's Bard, and repackaging it into a product off an integration effectively. There's just such a big difference. It'd be like me building a white label platform on someone else's technology and say we're a platform technology business.
Mhm.
That's just not reality. We're renting someone else's technology. So I'm not being dismissive of these businesses, because this is it's really interesting to see what the use cases are and what people are coming up with. What we're, I think, saying here, Danny, is that, hey, look, just be a user, experiment. That's all cool, but for God's sake, don't invest in these companies if you think they're an AI business. They're really not.
Yeah, yeah, good one.
Um, yeah. The other comment just to make here is, we always see this in a wave. So the first wave is always these smaller businesses doing these things, and then wave two is typically where the winners emerge.
Mhm.
So that's where you see things like Microsoft Copilot rolled out at scale, which is now, as of last week, available to all businesses.
Mhm.
Google will roll out theirs more meaningfully, and we're seeing phones coming out with AI. So for me, this sort of validates our thinking that AI is a is a feature, not a product. It's going to make existing products really cool.
Mhm.
Salesforce is doing some cool stuff with AI at the moment. I just think it's just going to infect everything we use. So the big question for me and in this prediction is just, are these small AI startups really going to survive when users work out in 6 or 12 months' time that the thing they're paying a few $100 a month for can actually be done out of the box by their Microsoft suite?
Yeah. Yeah. I think that's it too. And to your point, we've got Copilot and we've got a chance to sort of experiment with how we can actually use it because I think even at Finura, we're playing around with it, but where is it actually going to fit into our processes? We sort of haven't really defined that yet because we're trying to sort of see where it's going to help us. And again, the way that you use um, Copilot and ChatGPT and those sort of things versus the way that I use it and our other team members use it, I'd say is probably going to be quite different. So I feel like it's a bit of a one-on-one relationship that you have with AI potentially, rather than sort of taking over entire processes for an entire business, do you
Yeah.
think?
Yeah. It does feel like a personal assistant, doesn't it?
Mm, yeah.
More than a new person in your business, if that makes sense. Like it's sort of it's not like a robot behind the scenes with robotic process automation. That's really different. That takes over entire processes. AI's, yeah. And so, oh, gee, we're just day one in a multi-year journey, I reckon, with this.
Yeah.
So we're not, I don't think anyway, we're not underestimating the scale of what this
Mhm.
technology could do in the next 20 years. It will be
Yeah.
unbelievable. But we are quite pragmatic about the change management side of it and how long it's going to take for people to evolve. Because we've all been working for 20 plus years now, or certainly me, doing things a certain way
Mhm.
with computers.
Yeah.
um, and AI fundamentally changes all of that.
Yeah. Agreed. And I think, sorry, your other point too about using AI as a feature in products that are already out there. So I was using Canva the other day, and AI is now a feature in Canva, and it was pretty cool. Like it sort of really um, helped me put together my slide deck that I was doing in Canva. So, but again, it was for me, and I feel like it was a bit of a personal thing that I was trying to get it to do, and I needed to produce something that for one of our practices, and it was great. But I think just sort of again, just experimenting with those features, the AI features in your existing applications that you have in your tech stack is probably a good thing just to get your head around how it's all working.
Yeah, but I think our big red flag, if you are going to invest in some of these companies, and we know a lot of advisors do invest in tech companies in our
Hmm.
sector, and we're not to give advice on that, but what I would say is generally things like if you see the name .ai in the company or some AI thing, that's usually a bit of a red flag that the company is really marketing the AI stuff. It's sort of over promising that. In the same way we saw in the .com era that a lot of businesses just changed their name to .com,
Hmm.
like we saw pets.com, good example, in order to get those valuations. So you've been warned. That's probably
Do due diligence.
the key takeout there. Yeah.
All right. Great. Now let's move on to prediction two. So again, we've got another AI one. AI mania overpromises and underdelivers for advisors. So just to quickly recap, AI in the advisory sector, they often fall short with overhyped AI and Copilot applications emerging rapidly, which we just sort of covered a little bit. Yet we think many will fail as AI becomes just another feature in those existing products. And I guess despite AI's potential to boost productivity, the challenge sort of lies in that technology adoption and training for IFAs. Um, so, we sort of find that in the 2 point again earlier around change management. We've got a lot of things happening in advice businesses and a lot of issues outside of it that AI can't particularly really solve right now. It's sort of getting those foundational, maybe even boring stuff right before we move to AI to do those further enhancements, I think.
Yeah, we're certainly seeing a trend from the firms and companies, even large companies that we talk to, who are sort of trying to hit everything with the AI
Hmm.
stick to sort of say, oh, gee, AI will fix that. And even of our early experimentation with things like Copilot, like we dropped a sort of a templated SOA into Copilot the other day and got a PowerPoint deck out the back of it. But it was by no means would you put that in front of a client.
Hmm.
Just basically summarize the Word document and put it in a PowerPoint with some images. But, it was text heavy. It wasn't contextual. There was just lots of things that it was lacking. So I just feel that in our heads, we probably just got to be carried away around where we think we'll be in 12 or 18 months. The core technology will always keep getting better and more powerful, but fundamentally, we're still in the business of professional services businesses, and I feel that a lot of the AI benefits will be not more so on the the back office side of things, content generation, but I'm pretty realistic about how we as an industry adopt technology, and it's bloody slow.
Mhm.
Like I think about in the early 2000s when VisiPlan was trying to get everyone, which was sort of desktop software, was trying to get everyone across to Xplan,
Mhm.
to web-based software, and advisors saying, "Oh no, I don't want my data in the cloud," and I don't,
Yeah.
it was just like I just think there's just going to be this very long adoption curve to happen.
Mhm.
What is cool is the interest is there, and that's so exciting because normally, tech for a long time has been hard to get on the list, right, of things to talk about. But it's awesome that the interest is there. But I do feel that once the initial buzz sort of wears off, people are going to go, oh, gee, I still have some of those fundamental issues in my business,
Mhm.
and AI hasn't really fixed them. So I think that's what we're getting to with that AI mania. It is genuinely overpromising at the moment, and we would like to reset some expectations.
Yeah. Agreed. All right, now moving into prediction three. So we're saying here tech providers wrangle back greater control of their product distribution and service strategy. So just to summarize, we think this year tech providers are expected to regain control over their products and strategies, moving away from perhaps unsustainable discounting practices. And we do think that advisors should anticipate a substantial price reset as software companies reduce that reliance on those third-party intermediaries and that sort of thing. What do you think about this one?
Well, we were right because one of the big software companies just put their prices up yesterday.
We already ticked this one,
so,
haven't we?
so, so that obviously, fortunately, that happened after our predictions came out. Not that we like getting those ones right
Mhm.
because it means people were paying more. Look, I think there's a couple of macro trends here at play, and this isn't the first time we've spoken about this as a business. But the reality is, the advice market has shrunk.
Mhm.
It is effectively half of what it used to be. To add more complexity to that, it hasn't shrunk in a sense of it hasn't just shrunk, it's actually fragmented quite a lot. We have a huge growth in the number of IFA businesses out there who all do interesting different things and run different business models. But if you're a technology company, that makes it a lot harder to sell into, but also to support. So if we cast our mind back 5 years ago, most of the major software companies, and probably Iris is the best example because of their dominant market share, they had big institutional customers like banks. Effectively, the big four banks were, such a cornerstone of their customer base from an advisor perspective. And what that really meant is you sort of had one contract across, let's call it Commonwealth Bank, and you had a fee, and that was how they managed it. And within those organisations, the big banks, particularly those advice arms, they had big technology teams who did a lot of the heavy lifting
Mhm.
for the software company around implementation and support and all those things. That's all gone. Like even the large licensees who are listed on the stock exchange, they're still relatively small businesses compared to what we've had historically. And the feedback we're getting from the market is those technology teams are pretty thin on the ground
Mhm.
relative to the advisor numbers. It'd be a great thing to chart, actually, Danny, to go and do some research and find out what's the ratio between tech support and advisor numbers across the licensees,
Yeah.
because I reckon it'd look pretty different.
Yeah.
So this is just a market shift, right? And we're simply saying that for software companies to keep being screwed down on price on aggressive discounting in such a shrinking market can only end badly for everybody.
Mhm.
And the things that you know I'm really nervous about are advisors have really high dependency and expectations on their software now. They want it to get better and better. If there is no profit from selling software into this market, we cannot expect software to get better.
Mhm.
It's as simple as that. There needs to be margin for R&D to happen and all those things. Now, I understand the software companies are by no means perfect. They've got a lot to improve on, but at the same time, it's really hard to improve your products and your services if the entire conversation about software delivery in this industry is purely on price.
Mhm.
And we have seen uh, a situation in this market effectively where discounts of software have been applied across the entire market without any real, sort of strategy from what I can see, it's got to be wound back.
Mhm.
You know, we even hear it from our IFA customers, Danny. You know, they'll join these advisor communities, which are out there, and there's lots of them, right? There's about half a dozen now. And the number one thing they ask about is what discount can I get an expert?
Yeah.
Or what discount can I get with IntelliFlow or Advisor Logic, whoever? It just doesn't make sense to me, because for the software company, the smaller that business is, the more support they need.
Yeah.
The lower the margins are. So I'm kind of going into bat here a bit for the software companies to say we've got to change our mindset and our thinking, and it's not going to be popular
Mhm.
across the sector. But I just feel we're in an unsustainable environment at the moment. So I would expect those price increases to start rolling through quite aggressively,
Mhm.
and I would say that IFAs can probably expect a change in the dynamic of those relationships, which is going to hurt a little bit. But I think it's going to be better for us in the long run, because no one wins if these software companies go broke, as we've seen last year. No one wins.
Do you think, too, I almost think this is sort of a good thing, because I guess that discounted way of thinking makes people make potentially non-strategic decisions about their choices, and they're just moving to another piece of technology because it's cheaper. They're not actually sort of thinking about the long-term strategy as to how this is actually going to work. So in a way, people in advice businesses are going to have to be starting to think about, this cost, and it's a significant cost, as we're saying here, which means hopefully that more strategic thinking is going to go into those technology decisions, and can only mean good things for the advice business at the end of the day, I think.
Our research says that the average advice business spends 8% of their operational
Mm,
expenses on technology. And that's everything: software, infrastructure, all those things. In the US, the average IFA spends between 15 and 20%.
mm,
So you bang on. We're just going to have to invest more in tech. And I think the time's right, because I think with wage pressure, like inflationary pressures in businesses, you just don't have the luxury of just continually hiring
yeah,
people to sort of fix challenges. So I really hope so. But you know what? It's going to require the software companies to make some pretty tough decisions.
yeah,
um, and it's also going to require, frankly, licensees are going to have to kind of cop a bit here too,
hmm,
because a lot of them are looking to take margin on software,
yeah,
which adds to the costs base altogether. I think unless you can really demonstrate you've got enormous scale or adding a huge amount of value to that software relationship, I wouldn't expect those margins to last too much longer. So I feel like this is where we're at. And, like in every other industry in the world, you don't want to be a middleman.
yeah, yeah, agreed.
Um, so let's see
I think
what
also
happens.
too, and we do a lot of work with our clients around return on investment, ROI work,
Mm,
and 100% of the time when we look to the long term, initially, there's a cost involved in standing up a good technology solution. But in the long term, we 100% of the time see a positive return on investment for going through that actual process. So I think that's something else, advice businesses can really sort of start to think about when they're thinking strategically about their tech stacks, is how is this going to look from an ROI perspective as well.
mhm. Yeah, and look, to be honest, the average advice CEO, firm CEO we speak to is awesome with this stuff. They totally get
Yeah.
it. So I think everyone's made that mental shift. It's just the dynamics of the industry, and we've just got some legacy that has just not washed through.
Mhm.
So I would love a situation where software companies think really differently about their distribution strategies, and I think everyone will win in the future because of it. And I'll tell you what, just getting a standard pricing model across your software
Mhm.
company for all you, I mean, how hard is it for us with clients to work out what they're paying
Mhm.
for? So every price is different, and I can tell you, nothing pisses people off more than finding out a business next door to you, which is the same size, is paying 15 or 20% less for no demonstrable reason.
Yeah.
So yeah, that stuff's just got to be solved.
Yeah.
Anyway,
It is
I'll
annoying.
get off the
It is
soapbox on
it
that
is
one, Danny.
annoying. It's definitely annoying. When we actually are doing that ROI work, and we're sort of looking at the costs of software providers, even we do struggle to get get the answers as to what they are. So,
Yeah, yeah. Anyway,
all right, let's move on. Prediction 4: digital advice makes ripples rather than waves. So just to summarize, while multiple super funds will launch digital advice services in 2024, we think the actual user engagement and adoption rates may not meet those expectations due to potentially market saturation and existing legislative constraints. What do you think about this one?
Yeah, I mean, I think I'll put my hand up. This was mine. So I think at least 5 super funds will launch a digital advice offer to market this year. I think at least 1 or 2 of them will be more retail
Mm-hmm.
funds because they probably have more skin in the game to sort of mark, because they're probably a more net outflow than some of the industry funds, which just keep growing and growing. There is, of course, pressure from government, the retirement income covenant, and an expectation that super funds will have an advice strategy. But these organizations have a really broad spectrum with their experience, understanding, and supportive advice. Quite a number of very large super funds do not have an advice executive on their leadership team, for example. They tend to sit in member engagement and these areas. And I would argue that if you really fed income about advice, you would probably put and the senior executive on your LT to actually have a seat at the table, because advice isn't just a business unit, right? It's a service. It's a service that you want to roll out across your entire membership base. And I would argue one of the biggest differentiators you could probably come up with, because you can't really control investment returns.
Mm-hmm.
So I would love to be proven wrong on this and super funds to really, re-gear their organization. But if we end up in a situation where these things are just proof of concepts, experiments, all that kind of stuff, I think we'll see limited cut through because of the lack of support.
Mm-hmm.
I also think we have a habit in our sector of, if things don't work in the first 6 months, we tend to give up on
I
them
know.
and say they're never going to work. We're talking about a new business model, a new way of operating, and all the rest of it. So, strong view here is that we have good digital advice providers already in market. TiVo is a good example of one. They've already got 11,000 customers using their platform through direct, engagement and employer relationships. But when it comes to promoting digital advice to your members, it's really different.
Yeah.
So the whole education piece, the digital engagement, the prompting, the nudging, that stuff's going to take a couple of years to wash through.
Mm-hmm.
So I think the headline stays, but I think we won't see a lot of funds saying, "Oh, gee, we launched this solution, and in the first 2 months we had 20,000 members go through an advice journey."
Yeah.
I don't think that's going to happen.
Yeah. I think you're right too. Engaging members is the tricky one too. One of our 2023 predictions was that we got right was the client portal usage and the uptake in client portals in advice businesses. But we also sort of talk about the strategic thinking that has to go around adopting a client portal into your business, because it's the only piece of technology that touches that end client. And obviously we want to get a client portal and we want our clients to be using it. But as you say, it's another thing they've got to look at, another distraction on their mobile devices, all that sort of thing. And when you're looking
Yeah.
en masse at super fund members, it's changing that thinking, because I guess it's a bit of a psychological shift as well, which we know is the hardest kind of change and shifts to make when it comes to these sort of things. So, yeah, I'm with you on this one.
Well, I'd love to know how many super fund members actually have their funds app on their phone.
Mm-hmm.
That'd be interesting bit of data. The other bit of data I'd love to see is, if they have it on their phone, how many have it on their shortcuts or their home screens? Like in their actual, like their, for example, is it next to the banking app in the finance folder?
Yeah.
That for me is an important piece. So I think we just need to understand that if you're going to play this game of digital advice, you're competing for people's attention.
Mm-hmm.
People are going to engage with things when they're probably sitting on their couch at home watching Netflix, and at the same time they're going to have Instagram and TikTok and all sorts of things open at the same time. So I just, that's just me. Yeah, that's just me. I love multitasking, watching my reels. But you know what I mean? I just think it's a really different ballgame. So I think this one's going to take years to play out. However, I do think it's going to be a good year for digital advice providers that have their act together,
Mm-hmm.
because I think they're going to get traction, because I don't know if the funds really have the appetite or capability to build their own digital advice tools, because I think that probably would have happened historically. So more power to the digital advice providers who have been literally flogging away for years now. Hopefully this is the year where stuff starts to happen, albeit it'll be slow.
Yeah. Do you also think with the big institutions as well, it does take a long time to sort of get stuff off the ground. And there's a lot of decisions to be made amongst a lot of different teams and a lot of meetings and all that sort of stuff. I feel like we're sort of still stuck in that we're taking our time when it comes to technology development and that sort of thing. So, we kind of need to be a little bit more agile to move with the times, I feel.
Yeah. Yeah, just watch an episode of Utopia, and I guarantee you it'll be a similar process to what you see on Utopia.
Excellent. All right. Prediction number 5, startup pivots and zombies. So just to summarize this one, many wealth tech startups that secured funding in 2021 are facing capital shortages now, leading to potential zombie mode, characterized by reduced marketing and sales team attrition. And despite the funding, well, the tough funding climate, some startups might pivot, we think, possibly towards AI initiatives or just wait better market conditions to rejuvenate their operations. What do you think about this one?
Yeah, I think it's an extension of the AI thing, right?
Yeah.
Where I just think unless your business has this really interesting mix of getting product market fit right, really high quality team, and stable capital partner, it's just going to be a really hard year to keep raising capital because investors, like we saw with the administration of Advice Intelligence and Creative Mass, investors who just can't see a way out are going to they're not going to throw good money in after bad. So there's definitely that point. I think the zombie thing's interesting. I think we've already noticed a bit of that where we've seen sales team members disappear, lot more quiet on social media, those kind of things happening. And for me, that's usually a bit of an indication that they're just sort of battening down the hatches on expenses and just going into a bit of a quiet mode, hoping that conditions improve or something we haven't seen. But this is all just relevant for people doing due diligence for software companies, right?
Hmm.
That you kind of want to know they're going to be in business in 12 months' time, right? So
Yeah.
I think that's why we call this one out. I think that's what's going to happen.
Yeah,
Yeah.
and that disruption, right? If you are with a provider, unfortunately, Creative Mass or Advice Intelligence, and just that disruption to your business, if you were using that technology and sort of wondering what's happening into the future with them and that sort of thing, I think we need to be really wary of moving forward. And also,
Yeah.
I think just again to point out, we do have a shrinking advisor market and it's stabilizing now, I guess you could potentially say, but it's probably quite difficult for technology, especially new technology providers, to come here and really make inroads. I think just purely due to user numbers or available user numbers.
Mm. Yeah. Yeah. Totally. So I think I yeah, this is just part of the cycle. And let's face it, only 10% of startups survive.
Mhm.
So this is really normal,
Yeah.
you know. So let's see what plays out. But again, certainly wish them all well.
Mm.
Yeah, we started our business last 3 years, right? It's a hard yakka, and so just hopefully um, the funding environment improves and those things improve. But like what we saw with Creative Mass and Advice Intelligence, there are large institutional capital partners that are keen to buy these assets. Like they definitely
Mhm.
see some value. So and what's great about that business is quite a lot of employees in those businesses have now got
Yeah.
jobs at GBST, which is bloody awesome. So yeah, so hopefully that's what we see.
Yeah. And we want
Definitely,
the innovation, right? We do want the innovation. We want the
100%,
competition. It's really important and
totally.
healthy for us to have that.
Mm.
All right. Final prediction, which is prediction number 6 for 2024. Let's be friends. Unexpected alliances formed between technology providers. So what we're talking about, this is the collaboration between platforms and software providers, which I think we've seen with companies like CFS Edge and what they've done there from an integration
Mm.
perspective. That leads to obviously really good efficiencies for advice businesses. And it's really good to see the platforms and the software providers actually playing together and there for the advisor, listening to the advisors. They've had a lot of, advisor input into how this stuff sort of develops into the future, which I think is really good. What do you think?
Yeah, I think it's a product of shrinking market. That's the one thing. So we all have to collaborate a bit more if there's less customers to go around.
Hmm.
I think someone that you know, someone whose opinion in this industry I value greatly once said to me that co-opetition is usually the best long-term strategy for these businesses rather than eating each other up.
Hmm.
And I do agree with him on that. So that's probably what's fueling this prediction to an extent. I also think that certain organizations, and we've mentioned a couple in the report, like Iris is a really good example where they've had a bit of a punch in the nose with their share
Hmm.
price. But more importantly, some changes in leadership, which I think mean that people are a little less anchored to the business models of the past and are more open to partnerships and leveraging, the relationships in the market where because the reality is some companies are better at things than others.
Hmm.
So I think this is probably the most optimistic of,
Hmm.
sort of the predictions. How it all plays out, we'll wait and see. But there was probably just two things that were sort of on our mind with this one. The first one was that in the UK, Intelliflo launched a platform partnership with SS&C. So effectively, we're Intelliflo, we're effectively distributing a platform. Who would have thought that would happen in this market? So you can imagine, some parallels for this market in Australia. That's of interest. The other one is we have discussed in the report FNZ to an extent, who are, as you mentioned, launched technology with CFS, but undoubtedly will do more in this market. They're a massive business. They're a $20 billion US market cap business. So they are effectively 10 times the size of Hub24, 8 times the size of Net Wealth. So I think many of the local players will be quite threatened by a business like FNZ being aggressive in this market, and that may solidify some of those co-opetition type partnerships to just play a bit of defense against a new disruptive player coming into the market. So I think they're all the moving parts that we would see as to why some of these alliances may make sense. And from our perspective, any of those alliances that make platform and advice tech work better together is a massive win for advisors.
Because it's been sort of it's been probably more of an issue more than anything, has it, in the past, when you sort of think of the way they have integrated traditionally, which is data feeds going into advice CRMs, and how problematic they are. They take up a lot of time in terms of because there's inaccuracies and people have to talk to the software provider and the platform provider to try and resolve the issue and that sort of thing. So, I really like this one because that is a huge bugbear for the back office data feeds.
It's a very antiquated way of doing things. Yeah. Even, our friends in the UK that come in this market can't believe that's how we operate here in Australia, that we use EPIs instead of APIs for this stuff. Look, I would love to see Iress, Hub24, NetWealth, Macquarie, the key players get together and, without putting their commercial differences aside or commercial interests aside, come up with a new data standard that's going to work for the whole industry, that gets rid of this data feed challenge once and for all.
Yeah.
I mean, that for me would be a bigger impact than anything QAR is going to do for advisors.
Absolutely. I couldn't agree more. It flows into everything that advisors do, right? Reports, SOAs, ROAs, data feeds have to be sort of working to make all of those
the whole
work.
Yeah.
All right, so
I think we had one more prediction, Danny. There's a bonus one.
You've got another one?
I got a bonus one.
Okay.
Bonus
all
one.
Right.
So the final prediction is that, and this is probably where we're going to stretch ourselves a bit this year, but we do predict that a number of the major wealth players who are listed on the stock exchange may go private this year. So what do we mean by that? We basically mean that in many situations we will see listed businesses taken off the ASX, usually bought out by private equity or various other financial consortiums. And why do they do that? They generally do it because a business looks really undervalued relative to what's trading on the stock exchange. Perhaps the business is just having a lot of trouble transforming itself in that listed environment, or the acquirers, so the investors, see good stable cash flows, good stable business there, but maybe it just doesn't have the right management team, or a variety of factors that taking it private will just give it more flexibility. I've spent a lot of time with ASX listed businesses, and I can tell you there's not a lot of breathing room between quarterly investor updates and full year reporting and all the stuff you got to do to actually execute. I would argue ASX listed businesses probably have 30 weeks of the year tops to actually get shit done. So that's the appeal of going private for a lot of these businesses. And I look at the key businesses in our sector, and there is such a big difference between how the likes of Hub and NetWealth have performed from a share price perspective and the other listed players. So I'm talking about Iress, Praemium, Link, Insignia, AMP, Bravura. So, numbers in the last couple of years, your share prices of Hub and NetWealth were up nearly 38%, both of them. But if over the last 12 months, those other businesses I mentioned, you were down 33% for the year. So these businesses have been hammered with share price. And the reality is that unless these businesses can really articulate a compelling story to investors of how they're going to get their way out of this thing, people are just going to keep backing the winners, keep backing Hub and NetWealth. And even over the Christmas break, Hub share price went up another 15, 20%. It's looking pretty highly valued. So, I just feel, so the businesses in our line of sight on this are absolutely Iris, absolutely Praemium. Link has already going private, so I think that offer came in at Christmas to take it private. I think Insignia, AMP are absolute prime candidates as well, because if you get them out of that listed environment, they can be broken up more easily, sold off at different different components, and give the business a bit more breathing room. But the common, the learning, I guess, out of all this is that maybe 10 years ago, we loved doing businesses with we always thought that, heritage and history was equivalent to stability and all those things. But what this has shown is that those businesses like AMP and Insignia that have got literally 100 years of history, that's not a great thing anymore. That just means complexity and operational and cost complexity, where you look at the simplicity of the business model of Hub and Netwealth and look at them go.
Yeah.
So, because they don't have that heritage. Now, they will down the track, they've got to find a way through that. But that's what's driving this prediction. So we are already, we're seeing leadership changes in some of these businesses happening. I just think there's going to be quite a few go privates this year. And that's going to make actually our job harder, because we love getting public information about these businesses, because we kind of know what's going on, right? They go private, then it's very hard to find out what's going on. But that's probably the big prediction for this year from an ASX perspective. So we'll see what happens.
Yeah, I like that one too. And, again, hopefully, as you say, a positive one for technology and advice businesses overall going forward. The thinking becomes not as short term, and those resources, like you say, are sort of stuck in the operational side of things of trying to sit in that kind of model.
Yeah, it is. I think literally impossible to try and transform your business in a listed environment in a really dramatic and short term way, because the investors just don't give you enough breathing room.
Yeah,
simple as that. So, yeah, I think for some businesses it'll be a real benefit if that's what they can do. Yeah,
brilliant. All right, so we're going to catch up again probably halfway through the year, just to see how we're tracking on these predictions, see if we're sort of getting some of them right, or if we're way off track. So keep an eye out for that. And thank you for listening to another episode of the Wealth Tech Insider. If you haven't done so already, you can complete a technology health check. You can find that on our website, www.fenurogroup.com. And we look forward to seeing you again soon.